Hello, my name is James Halderson, and I am the lead developer and also the principal director of the Thetis blockchain project. So today we're going to do a smaller video that's just about the Elastic tokens and how they operate. So, what is the Elastic Token Standard? ETS Elastic Token Standard, a new type of rebase token that actively adjusts its price and supply to match the arithmetic mean of the top 10 performing cryptocurrencies to help avoid and negate market volatility while still having room to grow as an economic vehicle. So if we look at the little diagram here, this is the Elastic token and how it's roughly calculated. So we take the top 10, there's only 5 here just for space. We take the top 10 by market cap and we sum up their current value, their current price. We divide that number by 100 million and we multiply that by the PayPal holdings. Why 100 million? Because 10 million factor to get an incremental amount, and then the 10 for the Elastic token, that there's 10 things. So to get the arithmetic mean or the average of those 10, we have to divide by 10 times 100 million. And that multiplied by the PayPal holdings gives us this number here. Well, this was on August 27th, 2024 and is subject to change, but we will look at this live in action in a few seconds here. So what does this mean? A little more information on that. So there's some rebase tokens out there already that kind of, the way they work is by adjusting the supply of the token, because there's two factors that can change the price of a token. One factor that changes the price of the token is how much money is in the system, which is the market capitalization, the market cap. And the other factor that can change the price of a token is how much supply relative to that market cap. So if you have a token and it has $10,000 in it, and I have one token that's worth $10,000, but I make 10 tokens, they're worth $1,000 each. And that's basically the same thing as inflation when you have an inflationary system. So the way this system works is it's actually deflationary. It's a deflationary system, and we'll look at that in 1 second here. So let's just open up a live node here of the block matrix. This is on my machine. We're working on the back end networking right now. This is currently just local. It can do stuff on my local area network, but to make it worldwide, we're going to have to build the back end network. And that's what we're working on right now after the token presale. So we'll just say ETS here. Enter our current holdings for the ETS account. Now the reason why we're doing this is because, as I just mentioned, market capitalization is basically the same thing as the holdings of the token. There's no one distinct holdings account in most tokens. It's just in the ether, Ethereum in the ether out there somewhere. There's value because people have their money all around the world put into different pockets. And you can trade it by going through an exchange, centralized exchange. Now, that's the difference with the ETS token, is that there is no centralized exchange. It is the centralized exchange. There's a PayPal holdings account that rationalizes all the liquidity for the token. Most tokens only have 20-30% liquidity because that's how much is held by exchanges that are able to facilitate that transaction through brokerage. But when you have a PayPal account a PayPal holdings account built directly into the protocol, that's a completely different story, because then the liquidity is 100%, or I say approaching 100%, because there's some room for fluctuation, so like 98, 99% at any point in time. But we'll look at how that works in 1 second here. So first of all, let's say the initial value, which is how I got this number here, recorded on August 27th. We'll say that we have PayPal holdings account of $10,000. So this is live. This actually happens on the fly. And this will happen every time you make a transaction, that it's actually going to be calculating these numbers. So today it's worth $66,366. And again, that's why we made this incremental amount, because we're actually taking that number and we're dividing it by 100 million to get down to here, so that we can have a basis to base our price on with $10,000, and then grow that number based on how much money is in the token account to facilitate transactions back and forth. So that's the number that is the top 10 coins. If you average them out, you get this much. The initial price of each token is this 2066, which is about 2/3 of a cent per token. And that's with this much here, 10,000 inside of the current holdings account. So we run that through. If we filter it again by that to get this number here again, because the way the protocol is set up is that the basis is this will be the minimum ever in the holdings account. So we're saying that the very bottom is $10,000. The total supply of the token is 1,506,791.60, so 60 cents. $1,506,791.06. Well, not dollars, but that's how many tokens. That's how many ETS tokens there is. And the adjusted price based on this supply is, again, 2/3 of a cent. So going through those numbers now, we can look at how this changes and fluctuates and actually helps avoid volatility, because what's going to happen is that the more money comes into here, this price will increase the value of each token. But to rationalize that, we generate more supply of the tokens. And vice versa, if this number decreases, the only way that's going to happen is that you actually give these tokens back to the ETS protocol, and they're burned and then removed from this number. So let's say that the price went up to $1 million here. So we'll just say here ETS, and we're going to go up to 1 million. Does this live calculation. Again, this calculation will happen every time people are trading this token back and forth. It's going to be calculating this, rationalizing the value, and see how much needs to either be allocated or deallocated from the supply. So the average price here has not changed much, but it did change, right? It went down a little bit from there to $66,318. With $1 million, so we take this, again, this is the basis point, and we multiply that number by this, and we get, now it's worth 66 cents per token. And if we have 66 cents and there's $1 million in here, we have to multiply this number by that to get our total amount of tokens in supply at this point in time. So this has increased by quite a huge factor here, right? And this adjusted price, this is just telling you that when I do all these calculations, you know, I have this much, I multiply that, I get that, and this is the amount of tokens. Then I have 66 cents and 31 in the price here. So imagine that since we had $1 million here, just for demonstration's sake, if 1/2 of those tokens disappeared. So we'll say 500,000. And we're going to look at that number again. It's gone down again. So the prices are currently dropping. But as you can see, this amount of change here is nothing compared to if I had my token in one holding. If I just had one, I own only Bitcoin, I own only Ethereum, then you'd be losing 6-7% while we're losing like less than 1%, 2%. Because it averages it out. Just like in the stock market or cryptocurrency moguls, they'll tell you you should diversify your portfolio. You should have stuff here and there and all over the place, because when the market fluctuates, you have less of a chance of that fluctuation impacting you directly. So again, our base price here, and we took 500,000, they're now worth 33 cents, or about 1/3 of a dollar each. And as you can see, this number is exactly half of this number. And then that's 31 cents. So this is what would be the going price on the market at that point for the ETS tokens. So essentially what this is saying is that when I take these tokens and I trade them back to the Thetis project, they will then burn that exact amount of however much was traded so that we can get a supply that rationalizes the current value of the tokens. And that'll keep going on and on forever as people do transactions with the ETS token. So it's a pretty innovative way of looking at cryptocurrency as a financial instrument. And again, this is a deflationary system because, as money goes in here, this value is just going to keep going up. If we hypothetically hit $1 billion market cap, so it hasn't fluctuated much between those two prices here. It's about the same. A little bit of a gain there. So if we had $1 billion market cap, all of a sudden the coin goes up to $663.12 each. And that generates this amount of tokens here to rationalize this value here. And again, if suddenly half of those tokens went away just to, for the sake of demonstration, so again, here's our new price here. It's gone up a little bit again. So we had $500 million in here instead of $1 billion. Then the tokens would be $331 each, and this number again is exactly 1/2 of this number. So what that means theoretically is that half of the tokens have been burned because they've been traded back. So what that essentially means is that it's always a liquid asset. Other tokens, they have a liquidity, maybe it's 20-30%, something like that. This is 100%, or I say approaching 100%, because it could fluctuate a little bit. But whatever tokens are in here, their price is rationalized by a supply that equals the price of the token. So as tokens are sold, then tokens are burned. As tokens are bought, tokens are generated. And this balancing act between those two different states is what will make this a way more effective vehicle for investment than other investments, like other investment vehicles that exist right now in the crypto market, which have huge amounts of volatility. Of course, there is still volatility. As we can see, this price is changing. But since our price is only a fractional amount of that, and then we're generating however much, right? Like, we'll do $1 billion again, and then we'll look at the other one and see how much the price has changed in this token price. Okay, so here's our new token price, 662.17, and that was a few minutes after the first one that we did, which was up here, 663. So again, there's been a slight little change here, about $1. But what this is saying though is that negated a huge amount of market volatility. If the market is very volatile right now, and here you could be losing hundreds of dollars, right? We take a fractional amount of that, we tie it to the top 10 coins average price, we tie it to the amount of holdings that's currently there, and as an instrument here, it's way less volatile. It's still volatile, but way less volatile because I'm taking the average, like diversifying your stock portfolio. I'm going right down the middle, splitting the difference on both sides of the aisle here. And because of that, it's a safer instrument. It's not stablecoin safe, because stablecoins are tied to like USD, for instance, but it is tied to 10 different tokens that are performing well in the market. So we know that the price of it will be relatively stable as long as the market stays relatively stable. And even in large drops, if you're seeing 20% in one crypto token, you'll probably only see 4 or 5% here because of how it's been averaged out between all the different tokens across the market. And because it's inflationary, as we showed here, or deflationary, sorry, it's not inflationary, it's deflationary. It deflates. As more money goes into the account, more supply is created to rationalize the value. As these are sold, less supply is created because they're burned to rationalize the value. So there's a balancing act there. It's always trading between each other. So that's about it. Just wanted to demonstrate the ETS token, how it works, and the protocol in action, and why this is it's revolutionary. This is just one of the revolutionary parts of the Thetis block matrix, is the ETS token standard, which the ETS token will be Thetis's native token that can be traded across all the different blockchains in the block matrix. But people will be able to make their own elastic tokens that are very similar to this, using the same protocol, tied to whatever currencies they want, like different cryptocurrencies, or they can tie it to in the PayPal holdings account. It could be another currency. It could be like Canadian dollars, Australian dollars, or something. It could be like the yen. It could be whatever you want it to be. The ruble, who knows? And allow for the flexibility to change those parameters to fit your specific token's needs. As well, there will be, of course, just basic non-fluctuating, like non-elastic tokens that just behave as a regular token, or stable coins that are tied to, you can make a stable coin that's tied to a PayPal holdings account instead of having a fluctuating token that's tied to a PayPal holdings account. So there's a lot of variability. There's also a lot of opportunity there for people to get involved and build their own tokens with the protocols that pre-exist inside of the Thetis blockchain, or the Thetis block matrix ecosystem. All right, that's it for today. Just wanted to discuss this concept more in depth. There'll be more videos like this made in the future discussing the EBAs and other aspects of the block matrix more in depth. Thank you for paying attention, and we will see you next time.